To make the accounting information useful to various interested parties, the basic assumptions and concepts discussed earlier have been modified. The modifying principles are 1. Cost-benefit principle, 2. Materiality principle, 3. Consistency principle, 4. Prudence principle. Cost-benefit principle states that the cost of applying a principle should not be more than the benefit derived from it. For example, a proprietor realized that there was an error in his balance sheet of an estimated amount of rupees 6 lakhs. If he needed to find the exact amount of error, it would cost him around rupees 8 lakhs for finding the bills across his business locations. Since the cost outweighs the benefit, it is good to go with the approximate amount than the exact amount. The materiality principle requires all relatively relevant information should be disclosed in the financial statements. Unimportant information are either left out or merged with other items. For example, a company may have paid its office rent of rupees 20,000 in March for the month of April. Therefore, while deriving the balance sheet for the financial year ending March, according to matching principle, the company should consider the expense against April's revenues. However, when this amount is compared against the company's monthly revenue of rupees 5 crores, including or excluding rupees 20,000, does not make much difference in the balance sheet. Therefore, for such insignificant expenses, we can ignore the matching principle. The materiality principle depends on the size of the organization. For a small organization with a monthly revenue of rupees 50,000, the prepaid rent of rupees 20,000, unlike the earlier case, has to be appropriately accounted as per the matching principle. Consistency principle aims to preserve the comparability of financial statements. Same rules, practices, and principles should be applied in accounting year after year. We can compare the financial results of the business among different accounting periods only when consistent practices are followed. For example, depreciation of assets can be calculated under different methods. Whichever method is chosen should be followed consistently year after year. Prudence principle takes into account all prospective losses, but leaves all prospective profits. The essence of this principle is anticipate no profit and provide for all possible losses. For example, during valuation of stock, consider market price or cost price, whichever is lower.